Good afternoon, everyone, and welcome to the September 2023 edition of Epic Insight. This is Joe Corona. I'm the Director of Sales and Strategic Partnerships at Epic Retirement Plan Services, and I will be the host for today's call. With today's Epic Insight, we're going to embark on a two-part series on cash balance plans. Today's session will review how to uncover opportunities and how these plans operate. In our October Epic Insight, we will be focusing on the investment of cash balance assets with our colleagues at Payden and Rigel. When a business owner client comes to you looking to save more or defer more taxes than what their current retirement plan offers, the next option to consider is a cash balance plan. Cash balance plans can be a challenging concept or topic to be uncomfortable with, but they also present a great opportunity to cross-sell to your existing retirement plan clients, which allows them to defer more taxes while helping to supercharge their retirement savings. With that in mind, we're excited to have joining us our very own Matt Pine and Karl Willman. Matt leads Epic's Defined Benefit Actuarial Services team. Based out of our Portland, Maine office, Matt has nearly 20 years of industry experience and consults with clients on a variety of issues, including plan design, funding strategies, and pension risk management. Matt is a fellow of the Society of Actuaries and is an enrolled actuary. Karl recently joined Epic as a senior actuary. He comes to us with over 15 years of experience administering and designing defined benefit plans, specializing in cash balance plans. He helps companies maximize their retirement and tax savings through qualified retirement plans. Karl is a fellow of the Society of Actuaries, an enrolled actuary, and a member of the American Society of Enrolled Actuaries. Your line will be muted throughout the call, but if you have any questions you'd like addressed at the end of the session, please enter them in the webinar control panel and we will address them at the end. With that, I will turn it over to Matt and Karl.
Thank you, Joe, and good afternoon, and thank you for joining this webinar. This is Matt Pine, and I am joined by Karl Willman. We hope that you find this presentation helpful. Karl and I have the benefit of working with dozens of plan sponsors to implement cash balance plans every year. One thing that I find is that no two situations are identical, and there are often complexities that apply to one situation that don't apply to another. We'll try to cast a wide net and cover topics that you were generally likely to encounter, but you may have a situation that is more specific. Feel free to throw a comment out and we will address any questions at the end. Karl and I are also happy to speak with you and even speak with your potential client because some of these situations can be a little bit nuanced. So with that, I'm going to turn it over to Karl. Karl, the floor is yours.
Yeah, thanks, Matt. Thank you, everybody, for joining today and for having us here. We'll go through some basics a little bit about what a cash balance plan is and who the great what opportunities are out there, what types of clients, and then we'll get a little more technical into how we build a plan and show some examples. So starting off, what is a cash balance plan? It is a defined benefit plan, and it's commonly referred to as a hybrid defined benefit plan because it looks and feels more like a 401k plan, right? Most people are, familiar with a typical traditional defined benefit plan that pays an annuity at retirement age, but this is an account balance based, more like a 401k. So everybody understands an account balance today better than they understand an annuity stream at retirement 20 or 30 years down the road. And why cash balance? It's more robust from a funding perspective. We're talking about that compared to a 401k plan, right? The most you can put into a 401k plan, depending on catch-up deferrals based on different ages, is $60,000 to $70,000 in that range. And so that's the point, is we're layering more here, more opportunity for funding. So again, it is a defined benefit plan. We take advantage of the different different benefit possibilities, the different deduction possibilities. It's usually leveraged with the 401k plan. So this is not really in place of a 401k plan. This is usually added on top of, right? The first qualified plan route is to go through your 401k profit sharing plan, maximize that. And then when you're ready for additional contributions and deductions, you add this on top of the cash balance on top of the 401k. So we're not replacing anything, and really they work better when they're combined. We'll get much better results when we look at two plans together instead of trying to do it on a standalone basis. Again, much larger deductions available compared to a 401k defined contribution, and the cash balance plan is easy to understand and easier to understand, like I said, than a traditional defined benefit plan, right? It's more tangible to know what your account balance is today. So, like I said, a cash balance is a type of defined benefit plan. So why do you want a defined benefit plan? And it's in the name, right? The limit is on the benefit, and the benefit is defined in the document, and the limit is not necessarily on the contribution up front. You know, what you put into a defined contribution plan, whatever it grows or loses to, that's your benefit at the end of the day. But a defined benefit plan, the limit the IRS describes is on the benefit you could take out after the plan has run its course. And so we're kind of working backwards here. The limit that you can get out of a defined benefit or cash balance plan is in the neighborhood of $3.4 million. And there are some rules to that to make sure your person's old enough, the plan's been around long enough, has enough income. But we're kind of working backwards to say, what could you start with today if you have the cash flow to start putting in to accumulate towards that $3.4 million target?
You know, Karl, on this subject, one thing that I think is helpful is that $3.4 million, you could accrue that over a working lifetime, but you could also accrue that over a 10-year period. So we are often looking to shorten the horizon with the cash balance plan so those monies can be rolled over. You really have the greatest potential to maximize in that 10-year window.
Yeah, absolutely. And that $3.4 million is adjusted just like other qualified plan limits based on, you know, inflation, cost of living. So it will continue to increase. So again, how do they work? They're designed with the owner focus, right? We think of the cash balance plan as the owner's plan. The 401k plan is really more like the employee's plan. It's the employee benefit plan. You kind of have to have that, right, to attract and retain employees, just to get them in the door, let them save for their own. But we think of the cash balance plan as the owner's plan. The employees may have to benefit in that plan just because of the testing rules and everything involved in it, but the cash balance plan is not there typically for the staff. Again, it uses defined benefit nature, gets us much larger contributions, and takes advantage of non-discrimination rules. So if you're familiar at all with how the testing rules work with a 401k profit sharing plan, it's the same idea. We're just layering something else on top of it. We're giving more benefits. So just like the new comparability profit sharing cross testing, where these are black and white rules from the IRS. This is not subjective at all. We think this passes testing. We know exactly what the IRS deems as a non-discriminatory benefit, and you know we're taking advantage of, you know, the miracle of compound interest, right? That you know, a benefit, a dollar today is worth much more to a 25-year-old than it is to a 65-year-old, because we get to show that 25-year-old has 40 years to accumulate that money towards retirement age. So even though it's not necessarily comparable, we can get much larger benefits for the owners by giving smaller benefits to the staff that have more time, longer time horizon. So who are the ideal candidates for a cash balance plan? You're probably aware. The frequent users of cash balance plans are they're in the medical field, but it's not the only ones, right? So doctors, dentists, lawyers are high frequency users of cash balance plans, but really anybody, any business owners that have high income with strong cash flow looking for tax deductions. That's the key, right? Is There are pros and cons to this, and one of the cons is you have to fund this plan. It's not discretionary. So you want somebody with strong cash flow that's going to be able to fund this year over year. We also say target owners that are closer to retirement age, older rather than younger, for a couple reasons. Like the first, like just mentioned a little bit ago, those testing results, the way that it works out better if there's a bigger disparity in age between the owner and their staff, just the results will look better that way. But also we'll see a little bit, we talked about the limit you can get out. That limit is dependent on age too. So the older you are, the shorter your time horizon to retirement age, the more you can sock away to kind of accumulate towards that $3.4 million limit. What types of entities? Really anything, but we just have to know up front, right? Because there is a difference. If it's a corporation, we can only use their W-2 income. And it's pretty common for these professional business owners that have S-corps and they pay themselves a modest W-2 and take advantage of some tax situations by paying the rest of it in K-1 distributions. Now, there's nothing wrong with that, but it just kind of be aware that we can only use the W-2. We can't use the K-1 in that situation. So there's opportunity to talk with their CPA and make sure they're aware there's some trade-off here. You might have to take some additional compensation on the W-2 to be able to get larger benefits. And then proprietorships have Schedule C and the partnerships have a K-1 that have earned income. And it's a little bit of a circular calculation. So the plan compensation is there, just like a 401k, the net earnings after their self-employment tax deductions and after all pension contributions. So we just have to know up front. Don't just say I have a client that makes $200,000. Well, what is that income? How do they pay themselves? So it'll go into the design. We just have to know that. So why would a client want a cash balance plan? Well, it's the whole reason everybody's here, right? This is a tool for tax deductions. Obviously, there are other reasons, but that probably number 1 through 5. Tax deduction, tax deduction, tax deduction. So the other reasons, this is a qualified plan by the IRS, which is what gives us the basis for the tax deductions. But along with being a qualified plan, the assets are protected from creditors. So that's a good reason to start this plan instead of necessarily jumping straight to a non-qualified plan. You don't think of necessarily as asset protection as the reason to start plan, but especially medical professionals that have a lot of liability, this is very attractive to them. These monies stay tax deferred even through the life cycle of the plan. You can shut the plan down and you can still roll it over into another 401k or IRA outside of the plan and keep it tax deferred after the plan's run its course. Now, again, track and retain employees, not necessarily like the 401k goal is, right? Because you're giving that to everybody, but especially in these medical groups or law firms that have lots of partners, these are very widespread. So it could be a reason, a doctor decides to go to one practice instead of another because they have the opportunity to get this retirement benefit or to save on their taxes from their income. So it's really to attract and retain your key employees, not necessarily your everyday staff. And I guess last but not least is a significant retirement benefit, right? There's nothing small about accumulating $3.4 million if you get to that point, but think of that as that's kind of the secondary point. We're starting this because of the tax deduction, and it is a nice nest egg at the end of the day if you can support that. So shift gears here a little bit. What are the more recent updates to cash balance plans? And obviously the retirement landscape is all focused on Secure 2.0, and I forget how many articles are in that legislation, and 90-something% of them are all focused around defined contribution plans. There's not a whole lot of updates to DB plans, but here are some of the highlights that will impact the plans and the design. Just like DC plans, they're going to start pushing off the minimum distribution age. It's currently 72. It's going to go to 73, and then after 10 years, it goes to about 75. So I guess there's no reason somebody after 72 or after 75 can't have a cash balance plan. They can, but just know, just like DC plans, just like IRAs, they are gonna have to have minimum distributions withdrawn, which eats into the tax savings a little bit when you have to start taking those distributions out. But it's a good thing for us. The later the age, then the more viable these are for a longer period of time. One of the big things that came out of this for larger groups that utilize any defined benefit or cash balance plans is that they're going to stop indexing the PBGC variable rate premium. So some context there, the PBGC is the Pension Benefit Guarantee Corporation. It's a government entity that insures most pension plans. A lot of small employers are exempt from that coverage, but a lot of plans are covered, and it's kind of a pain to deal with. And there's two tiers of what you have to pay for this quote unquote insurance. One of it's like a per head charge that keeps increasing, and the other one's a percentage of, say, how far underfunded you are if the plan's underfunded. And for the last 10 or 12 years or so, that percentage kept increasing, and that doesn't really make any sense. I get that there's a variable rate premium. The people that are more underfunded have to pay more in, but it doesn't necessarily make sense that the percentage that you have to pay in keeps going up. So they finally capped that. The big one that I'm most excited about is retroactive discretionary amendments starting with the 2024 plan year. So this is kind of the answer to CARES Act that allowed us, I think it was CARES Act that allowed us to set up plans retroactively. And that kind of put existing plans in a little bit of a disadvantage, because you could always set up a plan retroactively, but you couldn't change an existing plan retroactively. If you wanted to increase benefits, you always had to do that before the end of the plan year. Obviously, decreasing benefits you have to do before benefits are earned. But this is a big deal. This will allow people up until potentially their tax return due dates to change their retirement plans if they need larger deductions. Also gives us some additional flexibility when we have to do corrective amendments if something fails. Gives us some additional tool in our belt to give some additional benefits wherever needed to help pass. All right, so what is the role of the advisor in helping with the cash balance plan? So the advisor is the trusted financial counselor, right? I can't go to my doctor or my dentist and tell them he needs a cash balance plan, right? They're going to look to their financial advisor. They're going to look to their CPA to tell them, should I do this? So you are the counselor of their retirement picture, of their tax picture. You're the plan design advocate, so you kind of go between us to help us figure out what the goal is when we design the plan. And from there, you can tell us how involved you want to be, right? Do you want to have every day-to-day contact? Do you want to not be involved at all? That's from the initial proposal and pitch throughout the administration. So it's kind of your choice as to what your role you want it to be in the plan. Obviously, the big thing the financial advisors are going to help out with the investments. And so you're interested in how are you going to invest this plan, and how is this different than what you already helped them out with the 401k plan? And that's a big key here is they are different, right? This is a pool of assets. There are not individual brokerage accounts for each participant. So you invest it for a pool. You take advantage of the larger account balances and the one pool of assets. There's no participant direction of their investments, which also means there's no participant education, right? You hand the participants the summary plan description. That's all they get. You don't need to tell them how it's invested. They get a stated return, and they don't care if the account gains or loses. They're guaranteed that benefit. Now, what's different in the 401k is the goal is not necessarily the maximum return, right? In the 401k, you want to get as much as you can according to your risk appetite. But in this case, you're aiming towards a specific rate of return, right? If we design a plan with a 5% rate of return, for example, that's kind of your bogey. You want to hit 5%, and it's no big deal if you hit 8% one year and 3% the next year. But over time, that's kind of the goal. So these plans are structured to reduce volatility and be a little more conservatively invested in their 401k. You know, the flip side of that is if you invest aggressively, you can defeat the purpose of the tax deduction, right? If you go out and get a 20% return, well, that's great, you've got more money, but it might mean you can't put in as much into the plan the next year, which means you have an increased tax bill. And on the flip side, because these are guaranteed employer contributions, employer provided benefits, if you underperform or lose money, you have to catch that up. Not necessarily all at one time, but you have to put more money in. And we're talking about significant contributions here. You know, a lot of people might not have the flexibility to put more money in than they initially planned. So think of that as, you know, that whatever that interest crediting rate is in the plan, 3, 4, 5%, whatever works out for that plan design is typically your long-term goal. So how do we build a cash balance plan? So the first thing we focus on when we start a plan is that basically, there's a few nuances to it. 40% of the eligible employees must have a meaningful benefit. And that meaningful benefit's kind of a gray area, but that's not necessarily a benefit like most non-discrimination testing rules where it's owners or highly compensated versus non-owners or non-highly compensated. This is just everybody. So our owner counts towards that 40%. So we start with the owner and figure out what benefit can they put in the plan to help us start that test. And if this is the only thing you get out of this presentation, this would be a good slide for you. This is where we'll start. Like, unless you tell us you have a specific dollar amount in mind or a specific goal for retirement savings, if you come to us with a 55-year-old business owner that says wants to maximize a cash balance plan, we'll start. If they have enough compensation, that 55-year-old can put away, starting in 2023, $241,000 into a cash balance plan. And you can see that goes down with age. Before that, it goes up with age as you get closer to retirement age. So you can see here we're, you know, sometimes double, triple, quadruple what you could put into just a 401k plan by itself. And these are typically in addition to what they're already putting into their 401k plan. There are some combined plan limits, but in general, this is what you're looking at. This is what you could do on top of an existing plan. So there's no magic limits here based on this chart. You could start a plan before age 35, but you see the limits start getting lower. It might not be worth the additional staff costs and additional administrative costs at that point. The limits increase after 65. There's a little quirk there where they go down between 62 and 65, but they start going back up again after 65, and you could continue on, you know, like I said, even past minimum distribution age. But again, if somebody has enough compensation and has the tax deduction needs, this is essentially the maximum we could start with 1 year of a plan design. So how do we build a plan? So we start with our owner as part of our 40%, and now we look at the rest of the employees. We have to provide a meaningful benefit to get to the 40% in total. So that can be a fixed dollar amount, it could be a percentage of their compensation, or some combination. We can pick and choose just 40% to meet that minimum rule, or small employers a lot of times want to be equitable. We'll give some benefit to everybody, so that we make sure that at least 40% of those benefits are considered meaningful to pass that IRS test. And then we go look at the 401k plan after that to pass all the rest of the IRS non-discrimination rules. So the combined plans, the 401k profit sharing and the cash balance plan, then are combined for all of the rest of the testing requirements that are also part of the 401k. This 40% participation rule is just a cash balance test. So some extra leverage, I guess, you can make these results look better if you have your spouse or children on the payroll for the business owner, and may or may not receive any benefits, right? But the spouse and children are considered owners by attribution to the business owners. So maybe put the spouse on the payroll just to get a little bit, maybe get their 401k deferrals, maybe a little additional dollars, or not. Children on payroll as long as it's okay with the CPA. Obviously, it has to be a reasonable wage, has to be legitimate, and they can I guess be eligible employees, and we can exclude them, and that way we have additional owners in the plan that are not benefiting. It might help reduce what you have to give to the rest of the employees. We can exclude employees by job classification. Like we said, we only have to get to that 40%. So not uncommon to exclude people by job class. You can really exclude whatever you want as long as it's not based on age. So it's pretty common in, say, a dentist plan. Maybe we'll exclude the dental hygienists because the hygienists are, the dentists already feel they're well paid. They don't want to give them any benefits. They're usually the higher paid and maybe older employees in that group that they're not going to help us pass the testing anyway. So just something to consider. We can pare this down a little bit. And obviously, owner-only companies get the benefits without the testing, right? It's just 100% of the dollars go back to that business owner. There's nothing to share it with the employees based on the IRS testing rule. So it's really about what's their appetite for how much they want to put away. So Matt, I'll turn it over to you, and we can run through some of the examples.
Carl? Yeah, so let's take a look at one of the most common situations you're likely to encounter, and that is a sole proprietor. In this case, we have a business owner, age 56, no employees. This plan is not going to be covered by PBGC, and therefore the defined contribution limit is going to be 6% of pay. So this is one of the nuances with a combined cash balance defined contribution plan, is that when you partner them together, there is a maximum deduction on the combined contribution. And while your cash balance maximum will be significantly higher, the 401k limit will be 6% of pay. So unfortunately, they're going to have to scale back what they contribute into their 401k. Let's go ahead and move to slide 25 to show what this would look like. So the first step would be to go to the chart Karl showed, where we can look at, well, what's the maximum potential for a deduction for an individual that age? Just about $250,000. In this case, the owner has $330,000 of W-2 income. When you put this together, it represents a combined total of about $300,000 of retirement savings. It's tremendously significant and far easier to discuss with a owner-only plan rather than a partnership with many decision makers. You may find that you encounter these situations more often than a small business, and we find that these are easier to explain and sort of the slam dunk that we hope for. So in this case, 100% of the benefit obviously goes to the owner. Let's go ahead one more, take a look at an example that's slightly more complicated and where we have employees. So here we have a small law firm with 3 employees, so 3 partners, 3 employees. Typically, what we would do is we'd look at adding a 401k safe harbor if that was not already in place with a new comparability design. Let's go ahead and move forward one slide here. So in this case, we have 2 partners. We have 3 employees. One of the employees is highly compensated. 2 of them are not. The demographics here look strong to start, just because we know we have 2 highly paid individuals, and then we have some staff. There is this one highly paid employee as well. The way we can structure this is the partners really have the ability to set their cash balance benefit based upon that chart that Karl showed. So in this case, what we're not showing you is the age, but presumably there's a senior partner here and a younger lawyer, probably in their 40s. So what we're starting with is, hey, let's max out the benefit to the two partners. The highly paid employee is being excluded from the plan. This is something that is an option, and if you're targeting providing the most benefit to the owners, the least to the rank and file, this is one approach. You certainly have the option to give that employee a benefit, but it's not required since their pay is above the highly compensated employee threshold. Employee 2 and Employee 3 are not participants in the cash balance plan. So if 40% of participants 40% of employees need to participate, we cover that with having the two owners receive the cash balance plan. So this cash balance plan is exclusively for the owners. The two employees, however, are still receiving a pretty significant contribution into the profit sharing plan, and this is in order to pass the non-discrimination testing plan requirements. So what you'll often find is that if the demographics don't completely work out, where you have, say, older owners, younger employees, you may have to give a little bit more to the employees, to the staff. That's what's going on here. In this case, the plan sponsors were happy to provide these employees with the additional benefit. It certainly worked out in their favor, being able to maintain the 94% of the retirement benefit on their own. So again, this is another strong plan design. Okay, so overall tax savings of over $200,000 with this plan design. Okay. Larger groups. This does work for larger groups. You may find partnerships, and these are less common to run into, but a larger law firm or a larger medical practice where there are, say, a dozen partners. This works very well for those type of organizations. You may lose your leverage, depends on how many owners there are versus staff. If it's, say, one owner and 20 staff members, there's quite a bit less leverage for the owner. There's a greater cost if you're having to provide a decent profit sharing contribution to 20 employees. So it may not work very well if you find an organization, or if you have a client who's a small business owner, just one owner, but perhaps has a dozen or a few dozen employees. Unless they're looking to provide something, or if they've already provided a healthy 401k contribution, there's definitely going to be a step up in cost to adopt a cash balance plan, just because you have 20 employees who are going to receive a contribution. So it's not necessarily going to be skewed so heavily towards the owner.
Yeah, Matt, my rule of thumb on that kind of is maybe 10 to 1. If you have more than 10 employees per owner, it's not going to work. But if you have 10 owners, but you have up to 100 employees, that might still work, right? Because you're still within that 10 to 1 ratio of staff to the ownership group.
Final point, look at the marginal cost. So again, this is always going to be the question is, well, how much more does this cost? If I'm already doing a new comparability formula, what is the delta? What does it add to my bottom line to be able to get the $200,000 or $300,000 credit? So this is where we often think of these as incremental plans. If they are already using a new comparability formula, cash balance is often something to layer on. If they don't have a new comparability formula, maybe there's no 401k plan in place at all, there could be quite a step up in cost in terms of what they're providing to the employees. Okay, getting started with cash balance. Short section here, and then we'll leave a Q&As. So for 2023, the Secure Act did change, or I think it was the Secure Act that allowed us to adopt plans retroactively. So really, right now is when we see most plan sponsors look at 2023 plans. That goes all the way into 2024. You really, if your client has extended their tax deadline, you really have up until that point in time to establish the plan. All funding with a defined benefit plan is due by the September 15th, or 8.5 months after the end of the calendar year. So, you certainly wouldn't be able to establish a plan after the funding deadline, but you can contribute as late as September 15th, 2024 for a 2023 plan. Practically speaking, just because of the paperwork, the documents that need to be signed, it's best to try to get these in place before, say, midpoint in the year. We try to cut off any new adoptions after July 1st. It gets a little tight with the amount of time you need to complete documents and fund the plan and complete the 5,500. So it's really better to do it during the beginning of the year and try to have it in place before mid-year. If there is a simple in place, just occasionally we run into this with a sole proprietor. Those can't coexist with cash balance plan, so any simple would need to be terminated by November 1st if you're looking to add a cash balance plan for 2024. Assets can be held at your favorite custodian. Our role in here is really to receive duplicate statements. We don't custody the assets, so we simply just need to have access or see an electronic statement to do our valuation work. Epic we can do the cashier, the pension payments when distributions are needed, if somebody retires and that pension payment is due. And we have 338 investment management available if desired, or we certainly know who to put you in contact with for that service. Okay. And finally, of course, we thank you for your partnership. We'll open up the Q&A here. Again, Karl and I are always happy to respond to emails or assist you directly with the client and help understand their situation and how cash balance can be a good fit.
Well, thank you very much, Matt and Karl. We appreciate all of the information. As Matt mentioned, we are going to open it up for Q&A. So if you do have any questions that you'd like to send our way, you can type them into the question panel. We do have a couple that have come in thus far. So the first one being, can you talk about a funding commitment? How long do I need to have this plan in place, and how long does it make sense for me to have this plan in place?
Yeah, I can jump in there. The IRS's buzzword is permanence. When you set up a plan, that doesn't mean forever. It just means that when you set it up, it's in good faith that it's going to continue on for the foreseeable future. So what does that mean? We don't know. The rule of thumb is at least 3 to 5 years. But if there's legitimate business reason, you can always shut it down sooner, right? So if you sell the company, or the business owner retires, or just the landscape of their business changes and not making as much money, you can always shut it down. I think the big thing is they're just trying to avoid like a law firm that has like a 1-year settlement that's going to give a large deduction in 1 year and then shut it back down. So it's not just a one-time deduction, it's for several years in a row.
Great, thank you, Karl. Another question that has come in. Can you talk about your experience taking over existing cash balance plans and what that process looks like?
Cover that one? Yeah, we often do. And in my experience, the one observation that I'll make is that when you do transfer actuaries or you change actuaries and move a plan, it's because the lifespan of these plans can be shorter. Sometimes they're 10 years, sometimes they're 5 years. It won't make a lot of sense to do it if it's really at the end of that lifespan. So in general, what I would suggest is that, you know, if this plan is nearing the end, it's probably going to be better to keep it with the current actuary if termination is on the horizon. If you're looking at a longer horizon to run the plan, then, you know, we do work and take over plans quite often, but we don't want to create additional costs or work if the plan is really ready to be terminated.
Great, thank you, Matt. Next question that came in, are there certain investment types that are not allowed for cash balance plan investing?
Well,
there
the
is
available options.
Oh,
I would say that they're pretty similar to what you could put into a 401k plan. You know, there are some things that we personally probably like to avoid. You know, we're okay with it if you just stick to your, you know, stocks, bonds, mutual funds, ETFs. But things can get pretty tricky if you try to put real estate into these accounts. And there's a whole set of rules around insurance as a separate thing. So that's not something that we typically would deal with. Matt, do you have something else to add to that?
Well, I'll just add, and that I completely agree with those points there. The ERISA has a, essentially you are required to act as a prudent investor, but it really leaves the door open. You couldn't invest in your own securities if that you were a corporation. And then, you know, what Karl said, I would just echo the illiquid investments are a headache to invest in. Certainly wouldn't want to do something like that.
Okay, great. Next one is talking about income. If considering K1 income as part of a total owner's compensation, can you only consider certain K1 income, such as line 14A?
Yes, I believe that's correct. From a partnership, we could count a K1. We would start with line 14A. This one is the net income. And again, if it's a K1 from a corporation, we can't add that into plan compensation at all.
Okay, great. Next one talks about contributions into the plan. Do participants or do contributions need to be made in the same dollar amount year over year, or is there flexibility?
So no, the contributions don't have to be the same year over year, but the benefit, I guess, is described in the plan document, right? So it's going to specify either a flat dollar amount or a percentage of pay or both. So let's say the person starts with a plan of $100,000 credit. In year one, they're expected to put in $100,000. You know, in year two, you know that there's a minimum required and a maximum deductible, that you're allowed to do something different as long as it meets the requirement, the contribution requirement. So you might have a minimum in year two of, say, you know, 75 and a maximum of 125. So you have the freedom to do something different there without actually changing the plan design. Now you can also amend the document to change the benefit, but again, the IRS doesn't want you treating this like a profit sharing plan and going up and down every other year. So as long as you're funding within, you know, the range of what that benefit allows, that's fine. And said you can change it maybe every couple of years, but don't say I'm gonna have $100,000 benefit this year and zero next year and 200,000 the year after that. That's what they're trying to avoid, is the big swings like that. Now, the flexibility we try to build into it is tying the benefit to annual compensation. So that way, if, you know, like I said, $100,000 benefit's a target for somebody that has a $200,000 W-2, we'll say the benefit is, you know, the lesser of $100,000 or 50% of annual pay. That way, if there's fluctuation in their revenue, probably have the ability to control their W-2 pay as well, and they can pay themselves less of a wage and then control their required contribution in that way.
Great, thanks, Karl. All right, last question that came in, and I'll actually ask both this question and one that's kind of tangent to it. What are the options if a plan is overfunded? And I guess the opposite would be what happens when a plan is underfunded.
Yeah, I guess in any given year, it's not necessarily a large problem, right? If it's on an ongoing basis, if you're overfunded, it might just mean you can't put in as much money if the maximum deduction rules don't allow you to do that. If you're underfunded, you might have to put in more money to help catch it back up. We are allowed to amortize these over a number of years, so you don't have to catch up all those losses at once. But maybe what this is going towards is when you're ready to terminate the plan, if you have an overfunded or underfunded plan at that time, it gets a little trickier, right? If you're ready to shut down the plan and there's too much in the plan, that can be a problem. If it's above that, $3.4 million, for example, of that limit, if you make it all the way there with 10 years of participation, there may be, you might not be able to shut it down right away. You might have to keep the plan open for a couple more years to get more years of participation in the plan, or to allow that owner to get older to soak up some of that excess money. Or you might have to share it with some of the employees at that time, or there are some other alternatives to avoid some additional taxation. And that's the ultimate downside is this money can be, if there's too much money in the plan, you could be subject to some excise tax upon reversion back to the employer. I guess if they're underfunded, it kind of depends on the plan design and how many owners there are, and if it's covered by the PBGC. If it's a PBGC covered plan and there's not any majority owners, nobody owns 50% or the more of the company, you have to fund it up. They will not let you terminate an underfunded plan. But if it's just like a single business owner, typically then you would pay the employees what they're due first, and the owner will just take what's left. That owner will take the haircut.
All right, great. Well, we'd like to thank Matt Pine and Karl Willman for this great session today, and we'd like to thank all of you for joining us for this Epic Insight webinar. As a reminder, we will be sending out a copy of today's presentation, as well as a recording of the session as a follow-up. As always, we wish you safety and health as you support your families, colleagues, and clients. Please don't hesitate to contact us if there's anything that Epic Retirement Plan Services can do to support you and your efforts. We thank you, and we look forward to having you join us for an upcoming edition of Epic Insight.